Your money is sitting in a bank account right now. And your bank is telling you it's safe. And your bank is lying to you. Not in the dramatic, Hollywood way. Not the 2008 way, where everything collapses overnight and people are lining up outside branches in the rain. This is quieter than that. Slower than that. And honestly, that makes it more dangerous. Because the slow ones don't make the news. The slow ones just happen. And by the time most people notice, the damage is already done. Right now, across hundreds of American regional banks, deposits are leaving. Quietly. Steadily. And the banks losing those deposits are the same banks sitting on loans that haven't been written down yet. And nobody in traditional financial media is connecting those two dots. So let's connect them. Here's what the official story sounds like. The banking system is well capitalized. Stress tests were passed. The FDIC has everything under control. And yes, a few banks failed in 2023, but that was Silicon Valley Bank, a weird edge case full of tech bros and venture capitalists. That's not your bank. Except here's the problem with that story. Silicon Valley Bank wasn't actually a weird edge case. It was a preview. Because the thing that killed SVB wasn't bad loans. It wasn't fraud. It wasn't some rogue trader blowing up the balance sheet. It was something so boring, so fundamental, so embarrassingly basic that the entire banking system was exposed to the same exact risk. Rising interest rates destroyed the value of long-term bonds sitting on bank balance sheets. And SVB just happened to be the first one to blink. But here's what nobody told you after SVB collapsed. The Federal Reserve ran the numbers on every other bank in America. And they found that over 700 other US banks were technically sitting on the same problem. Unrealized losses. Loans and bonds on their books that were worth significantly less than what they paid for them. The difference between SVB and those 700 banks? Their depositors hadn't figured it out yet. So let's talk about what's actually happening right now. Because this isn't ancient history. This is 2025 and 2026. Meet a typical regional bank. Not JP Morgan. Not Bank of America. I'm talking about the kind of bank with 40 branches, a local sports sponsorship, and a CEO whose name you've never heard. This bank did what every bank does. It took your deposits and put them to work. It bought treasury bonds when rates were near zero. It made commercial real estate loans to office building developers in 2021 when the world thought remote work was temporary. And then rates went up. Fast. And suddenly, those treasury bonds it bought at 0% are worth less than what it paid. And those office building loans? A significant chunk of borrowers are struggling to refinance because the math no longer works at higher rates. But here's the trick. The bank doesn't have to admit any of this yet. Because accounting rules allow banks to hold certain assets at their original purchase price instead of their current market value. It's called held-to-maturities accounting, which is the financial equivalent of closing your eyes and pretending your house hasn't lost value. And for a while, this works fine. As long as depositors keep their money in the bank never has to sell those underwater assets. The losses stay on paper. Nobody panics. But here's where the quiet bank run comes in. Because something changed in 2023. And it didn't stop changing. When the Fed raised rates, money market funds started offering 4, 5, sometimes even 5.5% returns. With essentially zero risk. And depositors noticed. Not all at once. Not dramatically. But slowly, steadily, rationally, people started moving money out of their low-yield checking and savings accounts and into money market funds, treasury bills, and high-yield savings accounts. This is called deposit outflow. And it doesn't look like a bank run. There's no queue outside the door. No news cameras. No panic. It looks like your neighbor quietly opening a Fidelity account. Your coworker moving her emergency fund into a treasury bill ladder. Your parents finally figuring out that their savings account paying 0.1% is basically a donation to the bank. Completely rational behavior. Individually harmless. But collectively? It's a slow bleed. Because when deposits leave, the bank has a problem. It needs to fund itself somehow. So it has two options. Option 1, raise the interest rates it pays on deposits to compete with money market funds, which compresses its profit margins and makes the business model harder. Option 2, start selling assets to raise cash. Which means selling those underwater bonds and locking in the losses it's been pretending don't exist. Neither option is good. And for smaller regional banks, both options at the same time is a genuine crisis. And here's the data that should make you uncomfortable. Since the Fed started hiking rates, US commercial banks have lost over $1 trillion in deposits. Not in a single crash. Not in a panic. Quietly. Over 18 months. The kind of number that doesn't make a headline but absolutely should. But the deposit story is only half of it. Because sitting underneath those deposit outflows is the commercial real estate time bomb. And this is where it gets really uncomfortable. American regional and community banks hold approximately 70% of all commercial real estate loans in the United States. Not the big banks. The small ones. The ones with 40 branches and local sports sponsorships. And commercial real estate is in serious trouble. Office vacancy rates in major US cities are sitting near historic highs. Buildings that were fully leased in 2019 are now 40, 50, sometimes 60% empty. And the loans against those buildings are coming due. Here's how this works. Most commercial real estate loans aren't 30-year mortgages like your house. They're typically 5 to 7-year terms. Which means a massive wave of loans made in 2018, 2019, and 2020 are now coming due for refinancing. And the developers who took those loans are looking at two problems simultaneously. 1, their buildings are worth less because they're half empty. And 2, the interest rate on their new loan is going to be dramatically higher than the one they're paying off. The math doesn't work. And when the math doesn't work, developers default. And when developers default, that loan on the regional bank's balance sheet, the one being held at original value, suddenly has to be written down to what it's actually worth. Which means the losses that were theoretical become real. Which means the bank's capital position gets worse. Which means depositors who were already quietly leaving have even more reason to leave faster. And that feedback loop is exactly how you get from a slow bleed to a real problem. Now here's why you haven't heard about this. It's not clickable. Regional bank deposits decline for 6th consecutive quarter is not a headline that trends on Twitter. It doesn't have a villain. It doesn't have a collapse date. It doesn't give you something to be outraged about today. So traditional financial media ignores it. And regulators speak carefully around it. And the banks themselves certainly aren't volunteering the information. But the data is public. The FDIC publishes it every quarter. The Fed publishes it. You just have to know where to look and be willing to sit with something that's slow and boring and genuinely important. Because here's the uncomfortable truth underneath all of this. The 2023 banking crisis never actually ended. It got managed. SVB got taken over. Signature got taken over. First Republic got absorbed by JP Morgan. And everyone exhaled. But the underlying conditions that caused those failures, unrealized losses, deposit outflows, commercial real estate exposure, those conditions didn't disappear. They got papered over. And right now, hundreds of regional banks are in a slow-motion version of the same situation SVB was in the week before it collapsed. Not identical. Not imminent. But structurally similar. Your deposits are FDIC insured up to $250,000. So if you're under that limit, your money isn't going anywhere. But the banks holding your community's small business loans, your local mortgage lender, the institution funding development in your city, those are the ones exposed. And when they pull back on lending, when they tighten credit to protect their own balance sheets, you feel it. Not as a bank failure headline. As a slower economy. Higher borrowing costs. Fewer small business loans approved. Less construction. Less hiring. The quiet bank run doesn't announce itself. It just slowly makes everything a little bit harder. So here's the corrected version of the story. The banking crisis of 2023 wasn't a one-time event. It was the first crack in a wall that hasn't been fixed. Just painted over. And the media isn't going to cover it this way. Because it's slow. And boring. And doesn't have a crash date you can put in a thumbnail. But if you want to understand what's actually happening in the financial system, the stuff that's hiding in plain sight, hit subscribe. Because the real threats never announce themselves. They just quietly show up one day. And by then, everyone acts surprised.